All right, welcome back. We've been talking about primary issues, and so let's talk about the law that regulates primary issues. Okay, the Securities Act of 1933. This is a really important law. It was the first major federal legislation to regulate the offer and sale of securities. And notice, 1933. It was after the crash of 1929. People in the government and in the public realized that we needed more oversight of the financial markets to try to avoid the crash, a repeat of the big crash that happened. And so one of the first things that happened was we developed the Securities Act of 1933, and all offers and sales of securities must be registered with the Securities and Exchange Commission, which was created. It's a government regulatory organization that was created to help deal with the offer and sale of new securities. And there are some securities that are, and organizations that are exempt from having to register with the SEC, but there are very few exemptions. The philosophy of the law is to provide full disclosure to investors of information that they need to assess an investment. All right? So, full disclosure is what regulators are after. All right? The law does not assess the merits of an investment. Okay? Whether it's a good investment or a bad investment, that is left up to the judgment of investors. Okay? So it is not the job of the government to tell the public what to invest in and what not to invest in and what prices to pay. That is the job of investors, but it is the job of the government to make sure that adequate, accurate, and full disclosure of information is made to investors so that they can decide. Let's check, make sure yes, we are recording properly, so let's continue on. So the issuer of securities, the underwriter of securities, the auditor who comes in and checks the financial data of securities, and the attorneys who help write the contracts are all liable for any false or misleading statements. So we want to make sure that if an offering is done, the people who are involved want to make sure that everything is above board and accurate. Okay? The issuer must register or fill out documents with the SEC and provide a prospectus, and I mentioned this, a booklet with comprehensive information about the company and about the offering, okay, to all prospective buyers. So buyers have to be given adequate information. Okay. Oops. And then there's something missing from this. Well, I guess this has to deal with primary issues, but let me just add that once a company goes public, they have to provide quarterly reports called 10Qs and an annual report called a 10K, and they have to meet full disclosure requirements when they provide this data, and they also have to provide reports if there is a material or significant event that happens. They have to provide data to the SEC and again to the public. This is all for public consumption, so a lot of information. A big cost of going public is having people on board who fill out all of the documents and provide this data to the SEC and to the public. And virtually every company that is publicly traded has an executive on staff who's in charge of what's called the Investor Relations Department, and that's the person that you call to ask questions about the company. Okay? All right. So let's look more at secondary markets here. We've looked at primary markets. Now let's look at secondary markets. All right. So secondary markets enable trading in outstanding issues. So once a primary deal is done, now the securities are out there. They're owned by investors, and now investors who want to buy and sell amongst themselves operate in the secondary market. So trading in outstanding issues. So proceeds from a sale do not go to the issuing unit, but they go to the current owner, i.e. the seller of the security. So now the issuer is out of the picture. Okay? The secondary markets serve two primary functions. First, they provide liquidity. Okay, it makes it easier for people to buy new issues. If you were asked to invest in a new issue, but you were concerned that if you needed to sell part or all of your holdings, you would have to find your own buyer, you might be less likely to make the investment in the first place. So you have the risk of the deal. Are you buying the right? Are you paying the right price? Are you getting the right security? Will the organization that you're investing in be successful? That's risk. But then the second part of the risk is, can you find a buyer for the securities that you're trying to sell? And so the secondary markets address that second risk, that liquidity risk. Okay? So again, prospective buyers of new issuers know they can sell the securities later if they need to. That's liquidity. All right, so the secondary markets provide liquidity, and the secondary markets also provide insight into the required return and valuation. Okay? And so if you take the market price and put it in the numerator, and you take economic fundamentals like inflation, interest rates, company fundamentals like sales, earnings per share, and cash flow, and you combine them together, all right, then what you create are multiples, okay? And we've talked about that in managerial finance. So the secondary markets give us market pricing. And when you combine market pricing with economic and company fundamentals, then you get valuation and rates of return. And so the secondary markets, when they were initially created, there was not this thought or idea that this insight would become available, but it is a byproduct of market pricing. What are people willing to pay for these fundamentals? What is the relationship between what people pay and inflation and interest rates? What is the relationship between what people will pay and the growth rates of sales and earnings and cash flow? Things like that. So there's a lot that we learn in terms of pricing, returns, and valuation from the secondary. All right, continuing on with secondary markets, let's look at the two types of market setups or market structures, the way markets are organized around the world. All right, the oldest type of structure is called an exchange. An exchange. All right, and with an exchange, there's generally one central physical location for the exchange, and the way it works is buy orders and sell orders from investors are directly matched up. So there are people who want to buy a certain number of shares for a certain price, and people who want to sell a certain number of shares for a certain price, who present orders to the exchange, and then the exchange matches those orders up so that the transactions can be accomplished. All right, and then of course the oldest and largest stock exchange in the world is the New York Stock Exchange. All right, and it's the largest based on the total market value of the issues that trade on the exchange. There's certain requirements to be on the exchange, which I'll provide to you. And so all the companies that have their stocks traded, if you take the number of shares times the price per share, it adds up to a total market cap of $19 trillion. Okay. And as I said, it's the oldest exchange. It was organized in 1817. And the average daily trading volume is approximately 4 billion shares a day traded, with a market value of about $170 billion. And so just to give you some idea, when I started in the investment business back in 1983, we would have about 400 million shares traded a day. So it's grown tenfold in the last 30 years. Okay, so a lot of growth on the exchanges. To trade on the New York Stock Exchange, a company must have at least $50 million worth of owner's equity, so it's got to be a pretty sizable company. They have to have $50 million of profits and contributed capital, $12 million of aggregate pre-tax income in the last 3 years, so they have to be profitable, and they have to have at least 400 shareholders with 1.1 million shares outstanding. So these are called listing requirements. To qualify to have your stock on the exchange, you have to meet this criteria. There's other criteria, but these are some of the main rules that you have to have. All right, please note that about 85% of trading on the New York Stock Exchange is now done electronically. It used to be done face-to-face, and I'm going to give you a listing of the people who work on an exchange, but it used to be done, trading used to be done by people, now it's done electronically, okay? And again, as I mentioned, the New York Stock Exchange is an auction market where buy and sell orders are directly matched up. And it is now the New York Stock Exchange is now part of the Intercontinental Exchange, otherwise known as ICE, okay? And ICE operates 23 exchanges and marketplaces in Canada, US, and Europe. So ICE is a company that has publicly traded stock, but ICE is a company that owns markets around the world. They are in the business of owning markets around the world. All right, there used to be regional exchanges in the United States, about 20 of them to be exact, and they were smaller exchanges, okay, and they were private businesses that catered to smaller companies that wanted to have their stock publicly traded. So smaller companies would go to these smaller exchanges. They had less stringent requirements, and they were traded. But in the last 10 years, two of the major market operators, ICE and NASDAQ, and we'll talk about NASDAQ in a couple of minutes, bought up these regional exchanges, and so they no longer exist. Except for one. There's one regional exchange. They're not illegal, they just economically, they don't make sense. The business models don't make sense. All right, international exchanges. So there are exchanges all around the world. We're going to take a quick look at the largest international exchanges. Okay, and the first is Japan. There are 8 exchanges in Japan, and Tokyo is the largest exchange in Japan, with a market cap of 4.4 trillion. That compares with 19 trillion for the New York Stock Exchange. And it is not the second largest, it is the third largest stock market in the world. Third largest, okay? Over 2,400 companies are traded on the Tokyo Exchange. We call it the TSE, Tokyo Stock Exchange. And now, London, the LSE, London Stock Exchange, it's the largest market in the UK. Their market cap is 6.2 trillion. So as you can see, it is the second largest market in the world behind the New York Stock Exchange. And they have over 3,000 companies listed there. And more than 600 of those companies are foreign. They're not based in the UK. And so there are more international securities traded on the London Exchange than any other exchange in the world. So London truly is the international exchange. Capital of the world, really. And so these three, New York, Tokyo, and London, will trade virtually around the clock. And so this is something I want you to know. At least for the New York Stock Exchange, it opens at 9:30 Eastern Time in the morning, and it closes at 4 p.m. So Central Time, that would make it 8:30 in the morning, and 3 p.m. is when it closes. Rocky Time, 7:30. Pacific Time, 6:30 in the morning. So if you're thinking about being in the investment business on the West Coast, you figure it's going to take you an hour and a half to get to work. The market opens at 6:30, so you're going to be leaving your house at around 5 a.m. in the morning. All right. Tokyo opens at 8 p.m. at night and closes at 2 a.m. and London opens at 3 a.m. and closes at 11:30 a.m. This is all Eastern Time. All right, there are 8 exchanges in Germany. The largest is in Frankfurt. Market cap is 1.8 trillion. These numbers are probably just a tad bit dated. China has 3 markets, and the largest is the Shanghai market cap of 4 trillion. So you can see that China's coming along with their trading markets. All right. I would note that the Chinese government still has controlling interest in most companies in China. That is communism. Okay, where the central government owns most of the enterprises. Okay, and then India has the Mumbai Exchange, with a market cap of 1.7 trillion. And so, as I mentioned in chapter 2, these two countries are really coming along and their markets are growing as well. And Latin America has one large market. It's in Brazil. Sao Paulo Exchange has a market cap of $1 trillion. So we are finished with clip 2, and yes, and we will move on to clip 3. Shalom.